Most of us wish to be affluent in the future. For the most part, becoming self-made millionaires is a far-fetched goal. But the fact is that accumulating wealth isn't all about hoping for someday. You can never start accumulating money too late in life. But if you start while you're young, you'll have a far better chance of amassing a fortune in more time to let that fortune compound as you become older. Learning a new skill in your 20s can give you enough time to master, and selling that skill can make you rich. So in this video, we are going to discuss how to invest in your 20s to be wealthy in your 30s. The video is going to be amazing, so make sure you stick to the end. Before starting the video, be sure to smash the like button and subscribe to never miss out on any of our videos. When it comes to investing, there's no one-size-fits-all answer. You'll need to figure out what works best for you based on your risk tolerance, financial situation, and personal goals. However, there are a couple of investments that 20-year-olds should consider. After all, the younger you are, the more aggressive your investment strategy should be. When preparing to invest in your 20s, it's important to consider how much money you can afford to commit to investing. To determine the amount, you might create a budget, which includes your income and your cost of living expenses, such as rent, utilities, and food. Using your budget as a guide can help you get started in finding some wiggle room in your funds to invest. Set goals. Before investing, it's important to understand what you want to do with the wealth you create. Creating a reverse budget is a good framework for setting goals and establishing a plan to meet them. And because reverse budgeting focuses on saving, you can't spend what you don't have. To start setting up a reverse budget, add up the amount per month you need to save to your short-term goals, typically 5 years or fewer. When you add up the expected cost of all these goals, you can more accurately determine what you need to save monthly to make it happen. Savings for these short-term goals should be kept in cash rather than invested in the stock market. Market volatility is inevitable. It's the cost of higher expected returns in stocks versus bonds or cash. So it's unwise to accept the risk of market losses for your short-term goals because they have less time, and sometimes no time, to recover. Just be sure to research the interest rates of checking and saving accounts when deciding to hold cash. For instance, high-yield savings account with a higher interest rate can allow you to earn some return without taking on market risk. This will also help ensure you have cash on hand when you need it. Pay down debt. One of the best investment approaches in your 20s is to pay off high-interest debt. If you owe money on credit cards, it may be helpful to pay off the balance before investing. Think about it. If you're paying 25% interest on a credit card or loan balance and only earn 8% on investments, you're drawing the short straw each month. Also, assess your lower interest debt, such as student loans. Does the monthly payment prevent you from investing as much as possible? If you reduce your debt, you will likely free up cash in your budget that can be used to invest. Enroll in a 401k. If you're in your 20s, a 401k is one of the best investment options for building wealth over the long term. If you have access to a workplace retirement plan, take advantage of the employer match. The match is typically a percentage of your income that is contributed to your 401 by your employer as long as you contribute a minimum amount. For example, your employer may match 50% of your contributions up to 6% of your pay, meaning they add 3% as long as you contribute 6%. An employer match is essentially free money and can help young people build wealth over the long term. Also, the contributions to a 401k can provide tax savings since the money comes from your paycheck before you pay income taxes. Don't try to beat the market. Investing is a complex activity, but that doesn't mean it requires a complex solution. The problem is that most investors get in their own way by unnecessarily meddling in their portfolios. While it's natural to want investments that beat the market, most investors taking this route underestimate the competition they face and the opportunity for success. This type of investment strategy can be great when you're right about the market, but terrible if you're wrong. There is also an overwhelming amount of research that shows both individuals and professional investors routinely underperform the market, but that doesn't mean you shouldn't invest. Instead, it simply suggests passive versus active investing will improve your chances for success. If you're a passive investor, you're in it for the long haul, which makes sense if you're in your 20s. The strategy requires a buy and hold. or stay-the-course mentality that limits the amount of buying and selling within your portfolio. Evaluate income and expenses to create a budget. A budget can help ensure you're living a lifestyle you can afford and can put you on a path toward achieving your savings goals. Start by adding up your income, then subtracting your expenses, including housing, utilities, car payments, food, and entertainment. Make sure you account for expenses that may not occur on a regular basis, such as car insurance, taxes, or healthcare expenses. If you find that you want or need to cut expenses, consider small lifestyle changes, such as packing a lunch, or even larger ones, such as living with roommates or your parents. Picking up work on the side will also bolster your cash flow. Once you've completed your budget, put together a plan for the money you have left. It's wise to start a rainy day fund for emergencies and begin making long-term investments as well. Make risk your friend. Many investors make the mistake of avoiding risk, even though it helps them over a long time frame. Reaching $1 million would require a reasonable allocation towards stocks. While investing in stocks can be riskier than, say, putting your money in a savings account, over the long run, stocks have shown to be a much more rewarding investment. Of course, when you invest in the stock, you'll probably see drops in the short term. That's why the market is generally a no-go if you need the money within 5 to 10 years. But history shows us that, in the end, you'll come out ahead for long-term financial goals such as retirement. One reason why investing in your 20s is so important is that you're looking at a very long term, which allows you to capitalize on all that growth. Bonds can generally be lower risk, lower return investments that can counter the risk of stocks. Make it automatic. Finances have a way of getting increasingly complicated as you age. Putting your savings, bills, and investments on autopilot can simplify things. For your investments, automating a dollar cost averaging (DCA) plan removes the need for determining the best time to invest by regularly contributing a set amount to your portfolio. For example, you could contribute $1,000 to an investment account on the 15th of the month for a long period of time. This allows you to diversify not only across asset classes but time. Making equal dollar purchases over time can potentially lower your average purchase prices because you buy fewer shares when prices are high and more shares when prices are low. While a lower average purchase price isn't always guaranteed, DCA is still behaviorally advantageous because investing at regular intervals reduces the risk of buying at the worst times and experiencing an immediate loss in value. DCA is also the simplest way to invest paycheck to paycheck. You don't have to do anything beyond setting up automated monthly contributions to your accounts. Start making these changes now. The long-term investment strategies and good decisions you make early in life will have more time to compound in your favor and set you on the path to financial success. Saving for retirement is not the only reason to make well-planned investments. Many investments, such as those made in dividend stocks, can provide an income stream throughout the life of the investment. 20-somethings have some definitive advantages over those who wait to begin investing, including time, the ability to weather increased risk, and opportunities to increase future wages. Even if you have to start small, it's to your advantage to start early. Let us know your opinion in the comment section below. This was all for today. Hope you liked the video. Do not forget to subscribe to our YouTube channel. Stay safe, and we will be back soon with another video.